This video goes over receivables. We all know that accounts receivable is a claim that a business has against a customer. The reason is because goods or services were provided to the customer by way of sales, but payment is not yet received from the customer. In other words, sales has been earned, but payment has not yet been received. The transaction to record this sales on account is a debit to accounts receivable and a credit to sales. When payment is received, it's recorded as a debit to cash, then a credit to accounts receivable to offset the previous accounts receivable balance. If originally the customer had paid cash for the sales of goods or services, then we would not have to deal with accounts receivable. It would have been recorded as a debit to cash instead of accounts receivable and a credit to sales. A company like Oakley, the cool sunglasses company, they have retail stores that sells to customers, and it involves the exchanges of goods for cash. But they also have a wholesale business where they sell to other businesses. And oftentimes, the transaction is on account. These credit transactions facilitate sales and is a significant current asset for many businesses. When there is credit transactions or sales on account, there is a risk of uncollectible receivables. Typically, there is a 30-day period for payment. If not, then maybe 60 days. Notes receivable is another type of receivables. It is a more formalized type of receivable. It's a contract, a written promise to receive money at a future date. Basically, a formalized loan. There's principal and interest. Accounts receivable is also a loan, but it's just not a formalized one. It's not written up into a contract with signature and date. Notes receivable, like accounts receivable, is a current asset. Notes receivables are often used for credit periods of more than 60 days. There are other types of receivables: interest receivable, taxes receivable, receivables from officers or employees. Interest receivable, that's if a business gives a loan to a customer, for example. It will collect back the principal of the loan along with interest based on interest rate and terms of the loan. Businesses may have taxes receivable when they overpay taxes and expect to receive a tax refund. They would record it as taxes receivable from the IRS. Receivables from officers or employees, it may be the case similar to taxes as a result of overpayment of payroll, as an example. There won't be much volume of these other receivables. Primarily, there will be accounts receivables.